Hello, everyone, and warm welcome to another webinar by Timber Exchange. As usual, we want to know where in the world you are watching from. So down below, press the chat button and let us know where in the world you are. Mike, where in the world are you?
Well, as you can see from behind me, I'm in Chicago. This building right here is the Board of Trade. So this is looking north into the downtown of Chicago. And I'd like to tell you it's 80 degrees and sunny, but it is about 35 degrees Fahrenheit and cloudy, and it is November in Chicago.
I think we have a lot of European viewers. So if it's 80 degrees, it would be scorching hot. At least in Europe. So we need to, if somebody knows what that is in Celsius, please do translate. So we have a few people that have commented. Welcome Rajan from North Carolina. Welcome Hani from Sweden. I see in the attendee list some good old friends. Don't be shy. Say hello. It was interesting to know where in the world you are. So welcome to another webinar by Timber Exchange. And in this one, we're going to discuss and learn about the North American lumber futures market. And as usual, this webinar is brought to you by Timber Exchange, your partner in tracking how the global timber market is performing, your partner in automating global timber exports, and your partner in timber inspection and timber quality assurance. And this week's guest is none other than STX Trading's very own Mike Wisnefski. But first, a small announcement. Okay. This year, we've had a really interesting year. We have spoken at Wood from Finland. We organized the first Dubai Wood Show Forum. And even we got the opportunity to speak at a United Nations conference on forestry. And what we do and what we have developed has really become the most comprehensive global timber market tracker in the world, where we measure and track every single month production, inventories, prices, trade flows, and consumption of softwood sawn timber all around the world. That is the quantitative side. But there's also a qualitative side, kind of like the webinar we're doing right now, where we allow you and help you to hear directly from market leaders from around the world. And since very recently, we started something new, which we call the Forecast Room. One of our clients that has 14 factories around the world said, Amir, can you come and tell the story of the market based on the short-term data that you have? So we did that. We took that challenge. And it was wildly appreciated. And it was really fun as well. So we're starting that every month going forward, where we will analyze how the timber market moves. We will identify early market trends by looking at the data that we have at our disposal. And we will try to understand why and how markets are changing. And we will also leverage, this is the interesting part, the collective insights of the audience where you will participate as well. And this is, of course, a add-on, and this is a private webinar for subscribers. So if you want, please reach out to me on LinkedIn, Facebook, or not Facebook, LinkedIn, WhatsApp, email, and we'll get you set up. But the timber industry is facing also some really big changes, mainly regulatory. There's the EU passport for products, but also global trade as a whole with electronic shipping documents. And this means that our industry is about to go digital, whether we like it or not. And it will especially affect products that are high volume or documentation heavy. And timber is both. So what we're going to see and what we are seeing is a convergence of these technologies, electronic documents, smart contracts, collaboration, and of course, shipment tracking, all in one place. And what this allows actually is for you to put a login button on your website where your customers, your suppliers can log in, and that this environment is branded with your company colors and logos. And combined, what this means is that suddenly, when these different things like market data and automation are improved, it helps you to improve your prices whilst reducing your workload significantly through all of these different modules: automation, tracking, market data, smart documents, smart tasks. And one of the more interesting recent things that we've launched, which is very appreciated actually, is also the timber inspection service, where we have built Europe's biggest network of independent, highly experienced timber graders that can quickly and affordably go out and inspect timber on your behalf and revert quite quickly after visiting the mill or the port with a report on quality, on dimensions, and any other important remarks. Because it's much better to identify these things prior to shipment than after they arrive. And now, without further ado, a warm welcome to our very good friend of Timber Exchange, Mr. Mike Wisnefski. Hello, Mike. Good to see you.
Hello, hello. How are you?
Good, thanks. Thank you so much for coming on and sharing actually probably the single best presentation that I've seen on this topic and on the North American lumber market. I'm really excited for this.
Thank you very much. You know, some of the things you were saying in your introduction about the digitization of the world and the digitization of the lumber market, it is coming. And much like a tsunami, it's coming whether you like it or not. You better be prepared. So I want to highlight why the company I work with is called STX Markets. And it's because back when the lumber futures was traded on the trading floor, before it was digital, my floor jacket and my acronym was STX. So you can see this is my old jacket and my badge. So when we would make a trade on the floor, you would have to write down the letters of the person you traded with, and then the number represented their clearinghouse or the company that handled their trades. And if you want to know why it's STX, it's because I traded sticks of lumber. So STX. In addition, nobody could write very well on the trading floor. So I wanted 3 letters that were very distinct from each other, yet they still messed them up. So I appreciate being in a digital environment more than you can imagine, because I don't have any mistakes. And when I come in the morning, all my trades are perfect.
And I know your background quite extensively. You really have a history in lumber, in trading lumber, and also in its digitization, which is very impressive, actually.
Correct. I've been in the industry since the mid-90s. I actually left the industry because in the late 90s, because it wasn't moving fast enough for me towards technology, and went into just the regular trading world of trading financial instruments. Which, by the way, anyone young listening to this, I highly recommend getting as many different experiences as you can when you're younger, because it really helps later on. So I learned how to trade financial instruments, and 10 years later, I was trading lumber on the trading floor in Chicago, both digitally on their electronic Globex platform and in the pit. And then it was that experience that I started the company Materials Exchange. Unfortunately, didn't little before its time, still, believe it or not, a digital marketplace for cash lumber. It worked. We had transactions happening, but we just need to tweak it again. I wouldn't surprise me to see something in the near future again.
Wishing you all the best, truly, and thank you so much again for coming on. Really excited for learning about lumber futures and understanding how we can use them in our regular operations.
So yes, but before we begin, first thing I want to do is apologize to everyone. On behalf of the futures trading industry, I apologize that we speak in a language that doesn't make sense to you. And it's unfortunate that the words we use have one meaning in reality and another meaning to us. My goal is really to be the ambassador of the lumber industry, and the liaison between the lumber industry and this futures trading world, and help everyone understand it. It is quite simple. The concepts you have to approach them a little more differently, but in the end, it's quite simple. And I am going to speak the best I can in lumberman's English as opposed to Chicago trader English. So the other thing I want to say is, if you're not using futures, you are missing out on an incredible opportunity. The brightest minds in the industry do use this, and they use it effectively day in and day out. So I want to get this presentation started. Don't worry if you don't catch everything. You will be able to get the presentation if you can get in touch with Amir. I believe you'll be able to watch it several times. And like, if you have questions, reach out. I really want you to understand lumber futures. So,
and we're going to have a Q&A at the end of this as well.
Perfect. All right. So let's get started here. Wow. November 27th, 2024. I didn't think I'd be saying that date already, but here we are. So we're going to talk about understanding lumber futures. This handsome fellow, of course, is me. This is a bunch of gibberish about what I just told you. So you can read that when you get the presentation. So we are going to take lumber futures and demystify them. So if this is the way you feel right now, don't feel bad. You're not alone. And hopefully we're going to get you off of this couch and into the world of lumber futures trading. So first, I want to address what a futures contract is, because this is where the terminology and some of the concepts become a little cloudy for people. So the important thing about a futures contract is to remember that it is literally a contractual agreement. It is not an actual physical transaction for lumber. It is an agreement to have a physical transaction in the future. And that's an important distinction, because you are not actually bound to do the action of the contract until the expiration date, or until the futures becomes present, until that contract expires. The unique thing about futures contracts are they are standardized, meaning every single one is exactly the same. Because of this standardization, there is a term called they are fungible. It's a crazy term. Sounds like mushrooms, but fungible basically means I can buy a contract and sell that contract. The action of buying it, then selling it, takes away all of my obligation. It essentially destroys that contract for me. Now, you can also sell the contract, meaning you would be the responsible party on the sell side of the transaction. And then at a later date, buy that contract, you call it buy it back, which will offset your responsibility. And once again, you are no longer responsible to sell and deliver lumber. So I know this may seem a little strange, but just work with me on this. And at the end, maybe, or after it's over, you can go through it a couple more times. So jumping into these key features, standardization. That's the most important thing you need to remember about a futures contract. They're all the same. Every single contract traded at the CME Lumber Group or CME Group Lumber Futures Market is the same, other than price and the delivery time window, which we're going to handle later. So the settlement method, there's two ways to basically settle a futures contract. One is for a delivery to happen. The other is for cash transaction. In the case of lumber, we have actual deliveries. So I say we have deliveries. It's very rare that a delivery actually happens, because most everyone will exit their positions prior to being responsible for that delivery. But what keeps the integrity of the contract in place is the fact that a delivery could happen. Now, this next concept, leverage and margin, this is the spot that trips people up. And this is where you'll hear the horror stories of how someone lost so much money. So when you trade a futures contract, it's called a notional value, or the total value of the product that is represented. In futures, you do not have to put that entire amount up or actually pay that amount if you're the buyer. You only put up a margin or a portion of it. It acts as a financial guarantee. Now, what's interesting in a futures contract is both sides of the transaction are required to put money up or to have money sitting in an account at their broker that guarantees that they will do what they say they're going to do. This is called margin. The leverage comes in that you can trade a futures contract with just a portion of the money up. So in lumber right now, the margin is around $900 per contract. The contract currently is trading around, call it $600. It is about a $15,000 value of the contract. And to engage in that transaction, you're only responsible to put up $900. That's where the leverage. So, with $9,000, you could actually trade $150,000 of lumber. That's the leverage. Now, risk management, these futures contracts, they provide a means here to hedge. Hedge basically is where you are pre-selling or pre-buying for a future production or future need. You could consider it buying ahead, selling ahead. This is where the futures contracts offer a very efficient way to manage that risk that you may have in your business. And we're going to talk about that later as well. Okay. I covered the leverage thing. You can read this again. And I highly recommend just, going online, and they will talk. You can find many articles about how this leverage action works. So let's just jump back and talk about hedging and what it means to everyone. So producers, let's just say you're a lumber mill. You sit here today, it's November 27th. You can have a pretty strong conviction that yes, you will be in business for the next year and you will be making lumber for the next year. The question you can ask yourself today is, what am I going to sell wood for on October 1st of 2024 or July 1st? Oh, I'm sorry, of 2025 or July 1st of 2025. Unless you have a customer base that is buying from you at that shipping horizon, you really don't know. Futures is a way that you can figure out on today what the price is you could sell for a delivery July 1st or October 1st. So it gives you the opportunity to potentially add some stability to your revenue. Now, consumer, this would, the term manufacturer is up here. A manufacturer that is a consumer of lumber could be a home builder. It could be a truss manufacturer, a wall panel manufacturer. It actually could be a box builder. Someone who's doing shipping, packaging, shipping and packaging materials. Basically, anyone who is in the business of taking that lumber and consuming it in their operations. Price stability, that's the whole purpose. It is to add certainty, add some clarity to where on today, where you can begin to see the selling price or buying price you can have for the product in the future. Now, speculation. This is another very important part, and it's an excellent opportunity. The futures markets make it very efficient for someone to participate in the action or the movements of the lumber market without actually having to take physically hold the contract or physically sell to someone. This gives exposure is a word that we use. It gives exposure to parties that are interested in this exposure, which could be a hedge fund. You know, the hedge fund comes up with a thesis or a theory that with the economic conditions and the market, housing market the way it is, we feel that the consumption of lumber is going to increase in the future, and they would like to place a bet, so to speak, on that happening. And they think if the consumption of lumber increases, the price is going to increase, they buy futures. Similarly, if they look at the market and they say, well, we anticipate the demand for lumber to go down. We do not see that the industry is going to right-size their supply. We feel there will be an oversupplied situation. They can go into the futures market and start to sell futures contracts, anticipating a fall in the price. And then they can profit by the price falling and having the value of their short or their sold position increase. They also like that, backing up the leverage. They really like leverage in the futures contracts because it allows them to have a bigger position with less capital, basically get more exposure to the market with less capital. Okay, so leveraging futures market data. Now we're going to start to get into the kind of the nuts and bolts of futures trading. The most important thing is for you to know what the futures market, I'm sorry about that, what the futures market price actually means and what it means for your business and your business decisions, and how you can analyze that data and analyze that market. But until you have a true deep understanding of what that actual number represents, it's just a number. It doesn't have any depth. The next thing is identify how your business will correlate to this futures data. The futures data, as you're going to see in just a moment, is a sliver, just a small slice of what the global lumber market. And when I say global, I'm saying across the world, across the product mix. But every stick of lumber correlates to another piece of lumber somehow. Sometimes that correlation or that relationship is really tight and they move in lockstep. Sometimes it's very loose depending on the product and where you're at. But identifying how your business and your product mix you use correlates is imperative. It's imperative for you to be able to make good decisions. Lastly, knowing how to use futures and executing your business strategy. I am going to shut this off. I apologize. There we go. Know how to use futures and executing your business strategy. Once again, very important. And the execution can make or break a trade many times. You can put the trade on properly and not take it off and miss the opportunity. So the knowing the execution side, execution meaning, putting that trade on and using it in your business decision. Okay, so let's jump into what is the futures market price. So this is the lumber future. This is what is defined by the lumber futures market. How do I say that again? This is the product that lumber futures is. It is one truckload, a US truckload that is, of 2x4s, number 2 and better, comes out to approximately 27,000 board feet, so about 42.5 cubes. And it consists of one unit that's 8 foot long, one unit that's 10 foot, 2 units that are 12, 2 14s, and 4 16s. So the first thing to note, especially for my Europeans out there, is this is imperial measurements. So it is definitely a North American product. I do want to give a quick shout out to North American Stevedoring. It is a company in Chicago that does reloading or warehousing. And this picture was taken at their yard. You can see the train in the background. They do a really, really good job there. So, okay, we know what the quantity is. We know the size. Now let's figure out, where did this wood come from? So the wood that is allowed to be traded on the futures market is spruce pine fir, SPF, in the western, that comes from the western section of Canada and the eastern section of Canada. Hem fir, Doug fir, and fir larch that come from the United States. So what has to be on that wood is a grade stamp that says, you know, this SPF, hem fir, Doug fir, fir larch, and it has to have been produced in Canada or in the United States. Now let's take a look at what's not allowed. Here's where it gets interesting. Hem fir, Doug fir, larch that is grown and produced in Canada, not allowed to be put into the lumber futures contract. Spruce pine fir that's grown in the United States is not allowed to go into the lumber futures contract. Euro spruce is also not allowed. Southern yellow pine is not allowed. So this is an important distinction when you analyze what's happening in the exact pricing of that futures market. Okay, so we know what the futures is. We know the size. We know where this wood's coming from. Okay, where is it going to? And this is very important. This is the delivery location. And it's Chicago. It's delivered into the Chicago switching district, which simply is this area in Chicago that all of the railroads meet. Actually, if you're a railroad buff at all, it's interesting to see how all of the railroads, basically the major railroads in the United States, all go into Chicago. So it's the perfect spot. And the futures contract states that this is a truckload of lumber, a truckload quantity of lumber of 2x4, number 2 and better, that tally, 8 to 16, that has been delivered into Chicago's switching district on a rail car. So now we've really narrowed this down. We've put, actually, literally, I put a pin on the map to say this is what lumber futures is. The last thing is when. So we know what, we know, what quantity, what species, we know where it's going. Now, when is it going to be delivered? So there are always 7 active contracts that you can trade, and they're spaced 2 months apart. Spaced 2 months apart, meaning when they have their expiration date, or when they come to the end of their trading time and they actually become a transaction. They're no longer just a futures contract. They expire, and then the contract states there will be a delivery. So these are the ones coming up are January of 2025, March, May, it's every 2 months, July, Sep, November, and then January of 2026. So this is where things get kind of interesting. Now you can see where you use this futures contract to do some business planning. How nice would it be to sit here today and know, oh, in 1 year, I can sell product for this price. Now I can make a business decision. Okay, now we need to narrow down exactly when that delivery is going to happen, because as we know, lumber is a volatile commodity and prices can move around. So it's important to know, just the precise time and place that futures delivery is going to occur. And this shows the previous expiration, which just happened, 2 weeks ago. The final trading day was November 15th. On that November 15th, if you still had a November futures contract in your position, you were going to be obligated to have a physical delivery or an actual cash transaction happen. And that delivery window was going to be in the first 2 weeks of December. So last trading day is the 15th of November. The window with which the delivery into Chicago has to happen are these 2 weeks. With this much specification, precision, now you can really hone in on what that price is and how that price is how to say occurring. What is happening in the actual market. Let's take a look at next year in 2025. These are the final trading days for each of the contracts. Remember, we said there were 7 open contracts. Well, I'm showing you 6 of them here. And these are the delivery windows. Now, this is where it's going to get really interesting. Currently, the January futures price is $592. So think about this. We know, now you know. So let's just think $592. A cash transaction is going to occur on January 15th. The delivery date is this window, the first 2 weeks of February. I'm just going to back up real quick. The wood looks like this. The wood's coming from these spots. The wood's going to Chicago. And the price is $592. The collective opinion of all the participants in the market say that fair value for a truck of lumber that we've specified previously that's going to deliver in this window, this green window, is $592. Now, if you have an opinion that's different than that, well, this is where you may have an opportunity. If you think the price of lumber is going to be higher at that time, maybe you should buy a futures contract. If you think it's going to be lower, maybe you should sell a futures contract. But what's important here is we've established what the futures contract is. We now can look at the market and see the price that's currently trading, and you can have an opinion. Here's where it gets increasingly interesting. The March contract is $617. Wow. That's kind of a significant increase. Evidently, the collective opinion in the market is that in this time window, this would be the price that participants today are willing to transact for a delivery in this window. This isn't saying that the price is going to be $617 in April. What this is saying is these participants are willing to transact today, do a deal today for a shipment in this window, and this is the price they're willing to do it at. We jump ahead May. Now it's $631.50. July, $633.50. September, $639. Oops, that's supposed to be 50. Sorry, typo. November, $656.50. Now, I will tell you a little aside. One of the reasons that you are seeing an increase in the prices as time goes on is called the cost of carry. And there are 2 things you could do. You could buy a futures contract, or you could just buy wood and store it. Let's say you needed wood for this, in December of 2025. You needed wood in 1 year. Well, you could go buy a futures contract, or you could go buy the wood and store it in a shed. If you bought the wood and stored it in a shed, what would that cost you? Well, 2 things. It would cost you, number 1, storage fees. Number 2, the cost of money. If you're borrowing that money, there's an interest rate to borrow that money. And the opportunity cost of what could I do with that money instead of putting it into this pile of lumber that's sitting in my yard. So that's one of the reasons you see the appreciation as you go further out. But we're gonna come back to this slide after we discuss some business theories, I guess you could call it. Okay, convergence. Here's another one of our futures trader terms that is maybe doesn't make so much sense to the average lumber guy. But convergence is simply, it's the movement of the price of futures towards the price of lumber in the actual market. And what causes this is as you approach that last trading day, that day where no longer is it a contract, it is actually an obligation. You will make a delivery. If you are a buyer of lumber and someone calls you on the phone to sell you some wood, they say, I'll sell you at $610, and you know that futures is trading at $590, you'd be like, well, why would I buy from you today for shipment in a time frame when I can go to the futures market and buy the same thing for cheaper? And of course, you wouldn't buy from the cash guy, you'd buy futures. And the reverse is true. If you're a seller of lumber and you say, oh, how would you like to pay $600 or $592 for my lumber? They say, no, our bid's $560. Fine. Bid all day. I'm going to sell a futures contract at $592. So what you can see is that the difference between the price of the futures and the cash market will converge to the same price because of the efficiency of the market being able to buy the cheapest or sell the most expensive product available to them at that time. This is where the opportunity lies. When there is a significant spread between the price of lumber futures and the price of the equivalent spot product, spot meaning the cash product, there's an opportunity. And this is where savvy traders or savvy businessmen will take advantage of that. All right. I know what you're probably saying to yourself right now. Well, Mike, this sounds great. I really like the whole idea, but I'm a European and I don't make that wood. I can't deliver into the futures. And you're 100% correct. You cannot. But what we all know is that there is correlations between the products. The actual use case of lumber, in many situations, it doesn't have to be the exact product that's futures. You could use European spruce instead of Eastern Canadian spruce on a project. So what happens is the European price ends up being related or correlated to that Eastern European price or Eastern Canadian price, which is correlated to the futures market. So it takes a few steps to get to the correlation, but it's there. So why are they correlated? Well, because they're made out of the same thing. Everything's made out of a log. The logs might be a little different. Use case of the product, basically the same. So now the way a log is cut directly affects the mix of lumber that it produces. And we all know about optimization software, which prioritizes the high value items and to the detriment of the low value. So it's going to overproduce what's expensive or high value, underproduce what's cheap, and those relationships will change or flip. Now, this correlation, it's influenced by market conditions, actual conditions in the marketplace. So if 2x4s are in higher demand and priced higher, this software is going to prioritize them and it's going to maximize the output of 2x4, which will increase the supply. Economics 101, supply demand. If more supply of a product comes in and it outpaces demand, price will go down. There is an interesting correlation here in North America. We see just about every year. And it's the correlation between 2x4s and 2x6s and where the product is used. Typically 2x6 is used more in the northern climates where you need a higher, more insulation in your wall. So as the building season in the north is in full swing, which is the summertime, 2x6 becomes more high in demand, prices go up. Now, as winter comes and the construction in the north slows down, typically the use of 2x6 slows down. 2x6 ends up in the spring being cheaper relative to 2x4. That's just an easy one to look at. So correlation, very important. Know how your products correlate to the futures and to each other. Well, know how my business correlates to the futures data. Here we're going to get into it. Okay. This is a fun slide, I think. So we define this is where the wood's coming from, and it's all going to Chicago. So we're going to take a look at this through the lens of a Nashville developer. So Nashville is right down here. So if the price of futures is $530, and it will cost about $30 per 1,000 board feet to ship wood from Chicago to Nashville. In Nashville, what he can, the Nashville developer can say is, I have a 560 futures equivalent in Nashville. He's starting to build this pricing model that he says, every time I see futures at 530, I know really that price means 560 to me here. I can use that 560 price in making business decisions. Now let's take a look at this through the lens of a hem fir mill. So once again, we have this 530s futures price in Chicago. Now we back it out, or we back out the freight that it would cost for the hem fir producer to get the wood to Chicago. You have a $430 mill equivalent futures price. The nice thing about being a hem fir mill in the Northwest United States is they don't have to ship to Chicago. They can ship basically anywhere. In fact, the Texas market is a big market for them. So what does this 530s futures price mean to a hem fir mill that ships to Houston? Well, their freight's 120 to Houston. It means 550. 550 Houston equivalent. So this is where you can start to see you need to build a model that relates this futures price to your business. All right. Let's talk about if you are an East Coast Euro spruce mill or producer, importer. We know these are the approximate locations of ports that Euro spruce goes into. I'm going to bring up a topic I call the zone of equilibrium. And this is the area where the users in this market, they don't really care if it's Euro spruce, if it's Western, Eastern Canadian spruce, they'll take whatever is the cheapest. This is where everything becomes equal. Now, it's all about freight rates, and the zone can move back and forth. This is, just an example. We can assume it's going to be $30 to get into the zone of equilibrium for futures. We can assume it's going to cost about $20 to get into the zone for a Euro spruce producer. Here's the math. You take your futures price, add in the 30 to get to the zone is 560. You take 20 out to get out of the zone back to the port. The futures equivalent port price is about 540. So just a slight premium to where the futures market is trading in Chicago. Okay. Now that we know this, let's go to the next step. How am I going to use futures in executing my business strategy? So the first thing I want to say is that, much like Amir was talking about at the beginning, the lumber futures market is the only source for market price data that is digital. This is huge. It's the absolute only digital price in the market. It is the only digital real-time price, meaning what's happening is at that moment in time, the collective opinion of all the buyers and sellers participating, that's a key word, participating in the futures market. If you're not participating, your opinion doesn't mean anything. And it is forward-looking. This is where the business strategy part comes in. It shows you a price that looks into the future and allows you to make decisions about future production, future consumption. So this is very simplified business math. If you have a business, you have an input cost, you convert this input cost and an output value. It's and you're going to understand this in just a moment. So a lumber producer, it's pretty easy. Input cost is logs. They convert it into lumber. A lumber distributor, their conversion process is actually maintaining an inventory of lumber or the distribution of that product. That's what their conversion is. A lumber consumer would be a builder. So their conversion process is taking building materials and turning it into a a usable structure. Speculator, they're just looking at the market for opportunities that they see. So let's take this lumber producer and look at the simplified business math. Here's a lovely sawmill. We know this input cost is logs. The output value is lumber. So if, as a producer, you know what your conversion cost is, and I'm not a lumber producer, so I don't know what goes into that, but I make the assumption that you lumber producers know how to do this. You generally know what your log costs are. So now you've got your input, you know what it's going to cost to convert. You don't know what your output value is. You have an idea. You think there's a price you would like it to be. What futures does is it gives you that opportunity to see what the output value could be. So let's look at our lumber distributor. They maintain an inventory. Sometimes that inventory is actually real wood sitting on the ground. Sometimes that inventory is orders. So theirs is kind of unique. The simple version is, I know what my distribution costs are. I know I can buy wood at, this price. What can I sell it for? And you can reverse this. You say, I know what I can sell wood for. I know what my distribution costs are. What should I be paying? Like, what can I buy at? The lumber consumer, here's their output value. It's a building. This is what they know. They understand their conversion process. What they don't know is their input costs. So they sit here and go, today in 2 years, I'm going to have a building that looks like this. It's going to take this to make this building, or this is the process I make the building in. They don't know what their input cost is. It's very important for them to have a good grasp of, for their estimating, getting their loans. What is it going to cost me from a material standpoint to convert it into a building? And then the speculator, you want to buy low, sell high, buy low. Pretty simple. All right. I want to go back to the screen because we know what the futures product or market is, or we know what's behind this number. Now we know what we can look at. We know how to build a model to relate this price to my business. Now I can look at it through the lens of the conversion process. And does a November futures price of $656.50, is that a good buy or sell for me? That is the business question. So why should we use futures? Well, number one, we tend to be unreasonably confident in our outlook. And this is just a human trait. So this is an interesting little graphic. There's this world that what you know, and we know what we know. Then, of course, we do know, we have a pretty good idea what we don't know. So, for instance, if you're a lumber producer, you know what your costs are, you know what your labor is, you can have a pretty good idea what your log costs are. And what you don't know is how the demand is going to be out there. There's some uncertainties for sure. But the one that really gets you is what you don't know that you don't know. It's the unknowable. It is a political situation. It is a weather situation. You don't know what it could be. It could be a pandemic. It's the thing you can't see coming. So if you really buy into this graph, you would probably take a look at the confidence of your forecast or estimate and say, even the economists know that they can't be accurate with their forecasts because they can only make a forecast based on the information they have at a moment in time. And as soon as time moves into the future, that information changes. So why use futures? Certainty in your revenue. A bird in the hand is worth two in the bush. I mean, this is an age-old saying. There's live to fight another day. Many different ways to look at having certainty in your revenue. Okay, I'm going to jump ahead a couple slides. I apologize. So what are the steps to start trading futures? Let's just say you're sold. You want to do this. You cannot deal directly with the CME group. They do not do that. They have a group of quasi banks. They're called futures commission merchants that have brokers that work for them. And you have to deal with a broker who deals with the CME group on your behalf. So the first thing is you choose a broker. There's many different ways to go about that. You set up an account, you fill out the paperwork. It's a little cumbersome, I am going to admit, but I have grown to appreciate the rigorous application process because it is a true vetting to make sure the integrity of the market is strong, meaning you don't have, the market won't fall apart and won't disappoint you in that there's non-performance. Lastly, learn and practice. They have demo accounts, which allow you to, they call it paper trade. So you put a trade on and just see how it would have worked out if it was an actual trade. This helps build some confidence and understanding. You do your research. In today's world, there's so much information available to us that you can learn online. And lastly, you need to place trades and manage your trades. Now, you can decide to trade using trading software. You can actually put orders in right through your phone, through your computer, or you could do it the old school way where you actually phone up your broker and you give the instructions to the broker, and then they are simply going to put them into a computer program. So, I lean towards using trading software because it gives you access to that data coming out of the market whenever, it's at your fingertips. And then you start by placing small trades to get accustomed to how everything works and the data flow, and absolutely use stop loss orders to manage your risk. There is risk inherent in this, so please use smart trading theories, and a good broker will help you with these. So final thoughts until we jump into a little bit of data and some examples. Consult an expert, don't go it alone. The expert is going to shorten your ramp to getting on board and successful trading and make sure you miss the common pitfalls. This one, it sounds so simple, but it's unbelievably important. It is so imperative to create a safe space for the decision maker who's making the call on a trade, that they're not going to feel attacked if the trade goes against them or doesn't pan out. If you think about middle management at a large organization, if they do a trade and it works out, that was their job. Great. If they do a trade and it doesn't work out, now they have fear for their job. They say, I could get fired. I was wrong. Well, okay, you were wrong. How could you know that you were going to be wrong? Like this falls into the unknown area of what you know, what you don't know, what's unknowable. So basically, give the person making these decisions the ability to have bad decisions from time to time. Explore, go fishing to find demand and supply. This involves you place orders in the market that are acceptable levels to you that may not be close to where the market's trading today, but if the order's in there and the market can see that, oh, someone's willing to sell at that price, someone's willing to buy at this price, the market has a tendency to move to the orders. It's just really interesting how that happens. So I think this is an absolutely missed opportunity for anyone who doesn't just put orders into the market. Lastly, just do it. Open the account, make some trades. Your decisive actions will help you learn, and in the end, you're going to achieve your goals. So, okay, Amir, I'm going to back up and just show. This is an example this is the actual chart of the January futures contract. So hypothetically, if you bought one contract on October 24th of this year, and you paid $552.50 for that contract, we now know that it was a contract to buy a truck of 2x4 from Canada or Western United States, 8 to 16, delivered into Chicago. Now, the market goes in your favor, and this is fantastic. The value of your trading account is increasing, and you're a brilliant trader. You decide you're going to exit that position, and you sell up here. It's covered up a little bit. You sold at $609. So the quantity you bought was 1. Your entry price was $552. Your exit was $606. You actually have made a profit of $1,485. Brilliant. Now, we talked about leverage before. The amount of money you had to put up for that trade was, let's call it $1,000. You were able to have almost 150% increase in capital and the capital required on this trade. That's leverage. That's 150% return on money in under a month. Now, this can go the other way. Let's just say on September 30th, you were looking at the market and you sold a contract at $545.
And by
Market base,
sold, meaning you expect the price to go down
correct.
in order to make a profit.
I should say you entered into the contract as the seller of the product. So you would need the market to go lower for a profitable trade. The market goes sideways basically for quite a while and then breaks out to the upside because you are a good risk manager. You had a stop loss order. You became the buyer of a transaction here at 582. Now, we know in our cash lumber market, if you sold something for $540, but when it came time to deliver it, you had to pay $580, $82 to buy the product to deliver, that you were going to incur a loss. And in this case, absolutely. This example, the trader sold 2, and the loss was $2,000. So in the course of 1 month, the trader lost 100% of their capital that was required at the beginning. Now, of course, you could have sold it up here and had it fall, and then you can make money. But this is just an example of that. Okay, this is a really busy slide. And what I encourage is get the presentation and go through this on your own. This is a hedging example for a producer, for a sawmill. So on January 5th, they look at the May futures contract. It's trading $585. They make a business decision. They go in and they sell 100 contracts, which represents about 100 trucks. The multiplier, the volume that is on per truck, is 27.5 board feet. So the total volume of board feet that they have sold here is 2,750,000 board feet. So, it's basically almost 3 million board feet they sold. The total value of that transaction, 1.6 million, the margin that they would have to put up, and this is where it's unique. Even as a seller, you have to put margin up, would be about $80,000. Now, on April 30th, it's time to exit that hedge, exit the futures trade. And at that time, May futures is trading $550. So the price for 2x4s delivered Chicago, this would be like Random Links would put this out. So the market for the cash is about $550 as well. We are making the assumption here that there was convergence. So if you then go into the cash market and you sell 100 trucks of 2x4 16s that you have sitting on the ground at the Port of Baltimore, and you sell them for $610, we're going to make the assumption that the futures market, that zone of equilibrium, everything, the futures price back to the port was probably like 560, 570, 570. You got a premium because they're all 16, so you sold at $610. This just tells you the actual 16 spread is $60. So let's do the math. You buy futures at 550. So you sold them at 585, buy them at 550. You have a profit of $35 on that futures trade. You invoice your customer $610 because you sold them 100 trucks, right? The size of your truck is 28.16 board feet. So your total volume that you sold was almost, 2.8 million board feet. All right. The total value of your futures, what you bought back, was 1.5 million. So you sold it at 1.6, you bought it at 1.5, you have a futures profit of $96,000. The price you invoiced your customer ends up to be 1.7 million. You add your futures profit to the actual sales, the revenue generated by your sales, that gives you your net. Your effective selling price was $644, which looks a lot like the May futures plus that, $20 premium that would be sitting at the port. Plus it's a truck of all 16. So you got, your $50 premium or $40 premium to that. So there it is. 585 futures turns out to be a sale of 644. This is where futures was falling. Here, you look like a genius if you decided to do this. Now, in a rising futures market, so you sold at 585, the market went higher. The market went significantly higher. Now the market's trading $700. But we also know that the cash market is going to be trading higher. So you're able to sell 100 trucks at $750. So let's do the quick math here. You sold futures at 1.6 million. You bought them back at 1.9 million. You took a $316,000 loss in your futures account. But you were able to invoice your customer at $750 a thousand for those 16s, generates $2 million of revenue. You back out the loss from your futures, gives you your total net, and your net effective selling price of $637. So on January 5th, you looked and you made the assumption you were going to get a price somewhere around this 637, and it was a good business decision for you on January 5th. Now, the one thing to note here is you would, in addition to, this is where it's kind of unfortunate, but in addition to losing money on your futures, you are going to actually have to put extra margin. You have to add that money, that loss, into your futures account as time moves forward. So it's the losses on futures, while they're not completely realized from an accounting standpoint, they're felt in that you have to add that money into your futures account as you're moving towards expiration. But the net price becomes the same. Okay. Amir wanted me to talk a little bit about what the market's doing today. So I'm just going to take a look at this chart, which I like this one. This is a 2-year, they call it daily nearby, which means they're always using the closest to expiration futures contract price. And that's why there's some gaps in this, because we went from recording the November contract, and then the next day we started recording the January contract, and there was a price spread between them. But when I look at this chart, I say, okay, for the last 2 years, we've been in a range with the tops being, right around that 620 level. The bottoms being right around 480. So, it's a $140 range. It's a significant range. But I think my big takeaway is we've spent a lot of time trading in the 5 480 to 540 range. So basically around $500 seems to be where overall fair value is. Are we overvalued right now? Well, there are some interesting factors happening in the market, which are there's less production coming out of Canada, out of British Columbia. The housing market, in this time frame, we were under a restrictive monetary policy in the United States. They seem to be loosening up interest rates. So, I could see the market easily going higher, and I could also see the market falling back into this $500 range. So I think we're at an interesting spot. Now, a couple of the things that I look for when I do futures analysis. I'm going to actually escape out of here for a second. So there's a ton of information on the CME Group's website, which is cmegroup.com. All you do is you come in, you click the little search, you look up lumber, and the lumber overview page. The nice thing here is it's going to, tell you all about the lumber futures contract, probably a little more in depth than I did today. Quotes, you can see where the market's trading at that moment in time. This is delayed by 10 minutes, but it's still pretty relevant, of course. Settlements, you can come here and you can see where they say that the market last traded at the end of the day, the previous day. This also gives you the number of contracts traded on the day, the previous day, and then the number of open contracts that are in existence. Right now, there's 7,000. And you can see margins. This doesn't change very often, but I highly recommend going to this page and just clicking around and seeing what's there. Now, the next spot that I think is really interesting to find information. Well, Bloomberg, you should always be going to your financial websites. In fact, this is today's Bloomberg. They have the U.S. home purchase applications rise to the highest since February. I'm always looking at that, looking to see what's happening in the cash market, knowing that the speculators out there are also looking at this same information. The Commodity Futures Trading Commission, this is a government agency that regulates the industry and keeps people honest. So they put out some information under their market data and economic analysis. It's called the Commitment of Traders Report. I'm going to click there. And what this is they show what type of trader is holding what, a buy or a sell. It's pretty amazing what they actually show. Lumber falls under this metals and other. We'll just click on the short format, and you got to scroll down until you find lumber, but I'm going to jump ahead. I have it already up here. So this report came out last Friday. It was dated November 19th. There's 4 different categories. This category right here, producer, merchant, processor, user, this is what we call the industry. These are lumber mills. These are distributors, anyone that has actual use of lumber or is producing lumber. Swap dealers, I wouldn't worry too much. It's basically a financials guy. Managed money. These are the funds. These are commodity trading funds that have zero interest in actual lumber. They just want to take advantage of market moves. And then other reportables are just individual traders, generally speaking. What it shows is, so whether long, meaning they were buyers of the buy side of the contract, short, meaning they were the sell side of the contract. So as of last Friday, not too surprising, the producers, the mills, were fairly well hedged up. They made up 70% of the sellers of the contracts were someone of the industry. The people who had bought them, kind of evenly distributed between people in the industry, managed money, other traders. But this isn't always the case. This is just what happened on last Friday. So now I'm going to go back to my presentation. Okay, I want to show you something. So this November 19th is the report we just looked at. You can see the numbers are the same. About a year ago, on January 9th, we take a look. Oh, okay, well, this is kind of boring. The numbers are basically the same. So do things change or not? Well, here's those two. This was from July 30th. Now look at the number of people selling from the industry was very low. The number of people long, meaning the buy side from the industry, was really high. It's almost flip-flop from where we are today, or down here, where we are today. And if you look at the managed money had been sellers. They were short. They held the sell side. Other reportables were also long. Okay, how does this show up? Let's go back to the chart. And so right here, the industry was short and the funds were long. Down here on July, this is where the funds were all short. This whole down move, the most aggressive sellers were the funds, the financial guys. Then to get back here, the financial guys started to cover and buy back their positions, and the industry started selling into it. So essentially what I'm saying is up here, the industry tends to be hedged, meaning they've sold it, and the funds tend to be long, meaning that they have bought it. So just a little tidbit of information.
Incredibly interesting and sometimes a bit funny. You're a really, really good storyteller. Really, really well done. Maybe the crowd can't clap, but I certainly will. Very well done.
Thank you. Appreciate it.
So we're going to open, as usual, the floor for Q&A. So down below, there is a button called Q&A where you, the audience, can submit your questions to Mike, which I'll be moderating and asking. Let's take a minute to await some questions from the audience with a short announcement. So on December 13th, we will have the next forecast room. We'll be analyzing monthly global timber market data, production levels, inventory levels, and prices. We'll be identifying early market trends, understanding why and how things are moving, and most interestingly, leveraging the collective insights and knowledge of the audience. And then there's something very interesting as well. We started recently to track the sentiment. What we just saw, what Mike was doing was the sentiment of companies trading lumber futures. But what about everywhere else in the world? Nobody is tracking that. So that is what we have started doing since this summer. And what we can see is this summer, for almost 50% of people believed prices would fall. Now the number of people believing prices would fall are just 7%, almost nobody. It's negligible. And over this time now, the majority believe actually in increasing prices, which is really, really positive and very important. And what's most interesting is these 100 managers, directors, owners who are voting, if we combine the capacity that they represent in terms of production or trading or procurement, it's at least 20 million cubic meters, if not 30. That's almost 10% of global production. And we're going to be deep diving to this and much more on December 13th with the latest data. And now let's see some of the questions that we have received from the audience for Mike.
That first one I really like about the Southern Yellow Pine.
Yes, let's see. Somebody's asking, any particular reason the SYP lumber is excluded whilst SYP represents 1/3 of the total US lumber consumption? Thank you very much.
So two ways to answer that. Number one, it's excluded because its use case is just different enough that including it would muddy the waters. And when you look at the price differential between Southern Yellow Pine and Western Spruce, or Spruce, I should say, SPF and Hem Fir, they don't correlate enough to put Southern Yellow Pine in the basket, if you would, of the current futures contract. And I want to highlight current. It is very likely that there will be a Southern Yellow Pine futures contract launched this spring by the CME group. I'm not an official at the CME. I have friends that I communicate with there, and they're working on it. They have a lot of interest in this. So I believe there will be a Southern Yellow Pine futures contract. And because it's basically because it doesn't correlate directly tight enough with SPF, they're going to make their own contract for it. So that's very exciting news.
Thank you very much, Mike. Very, very, very important as well. And I've also been seeing signals of SYP futures coming up. The next question is from another viewer. He's asking, wood is a live material. How can you ensure the quality if prices change? So, Mike, with these, let's say it's a physical delivery of the lumber.
Yep.
Are there any quality requirements? And if there is a problem, what actually happens?
Very good question. Yes. Back on that CME website, you can find the rule book and read through it. It sounds like legalese. It sounds like a legal contract. It is very specific as far as quality goes. And if the quality is not up to par, the seller has to either make it better or gets fined significant amounts of money. So yes, the rules state what the quality has to be, and you have to meet the quality, otherwise you will get fined. And you don't get paid until the product is accepted. So you're not, as a seller, you meet the quality, otherwise you don't get paid.
Very interesting. The next question is from another viewer. He's asking, can an individual trade with a couple of $1,000s?
The real answer is yes. The question is for how long? Many times you enter into a trade because the market is always trading at the collective fair value of all the opinions of the market participants. If the market goes against you and the requirement of your broker is you need to put more money in your account, your losses could take your account to a level that they would liquidate your position. So the answer is yes. It's kind of risky to trade with just a couple thousand in your account. I would say realistically, if you want to trade one contract, you could trade with $10,000 in your account and trade fairly comfortably.
Very interesting answer. Thank you for clarifying that. We have an audience member who has raised his hand. It's Mr. Indulis. Mr. Indulis, if you want, I can grant you access to speak, or if you want to submit your question in the Q&A, please let me know. Welcome back to Mr. Indulis. The next question is from another viewer. He's asking, is there an index for plywood, or is lumber futures correlated to the general construction market, which includes plywood?
There was a plywood contract back in the late 80s, and it just didn't get enough participation from the industry, so it went away. I don't think there is a tight enough correlation between plywood and the lumber futures market to do any sort of risk management of plywood prices with lumber. That's just my personal opinion. I would love to see a contract for that. The key for any new contract is just making sure that the data is available to settle the contract at the end. But the short answer is no, there is no index for plywood at this time.
And maybe the final question in today's Q&A, please write quickly if you have a question. The final question, okay, now the questions are starting to come in. The next question is, what is your business's biggest risk if you use leverage well? Never losing money, is my understanding right? Because leverage goes both ways, right, Mike? If you start losing, you start losing much bigger.
Correct. Absolutely. So, you know, when you look at it through the lens of a speculator, you see leverage as an accelerator, you know, of the profits or the loss. If you look at it through the eyes of a hedger, the leverage is a very efficient way to not have to use so much capital to manage your risk. So look, the biggest risk is just being wrong on the market. You know, if you do your analysis and you think it's going to go one direction and the market goes the other direction. As a speculator, utilizing proper risk management techniques is paramount. Otherwise, you lose all your money. So the biggest risk is being wrong. It's truly that, being wrong and not managing your trading risk.
Indeed. This is very, very sensitive. So I urge everyone, if you do this, like Mike said, follow his advice, work with a broker, start very, very small. It's, I'm not going to say like Bitcoin, but it's certainly like the stock market.
Lumber is one of the most volatile commodities out there. So which attracts a lot of interest, because if you're going to speculate, you want to speculate on something that's actually going to move. You want to have an opportunity.
Okay, so maybe a little bit like Bitcoin then. The next question is from Artis. I think you might need to clarify, Artis. What about roundwood sales? Similar system or different?
I think he's talking about logs.
Yes.
And there is no futures market for logs. I think it would be really cool if there was. You could build a model. I don't know that side of the business very well, but I'm sure you could build a pricing model where you say, look, if you know, output prices are such, we should be paying X for our logs. So the correlation is a little loose, but I'm sure you could do it. But there is no market for the roundwood for logs. I really want to answer the next question because it's so important.
Yes. The next question is this. According to the latest report, November 19th, was the majority of contracts sell or buy? And this is interesting, Mike, because you showed and we saw that different types of companies have vastly different positions. In fact, contradictory.
Correct. The answer is they're equal. To create a contract, you have to have a buyer and a seller. Every contract has a buyer and a seller. So they are absolutely equal. What I was showing is what type of trader or what type of account at that moment in time had more sell contracts in their position or more buying contracts in their position. But the overall number of buys and sells is always equal. What that report shows is when you look at the industry as a silo by itself, is the industry majority of the sells or the hedges. If the industry is not, then you could say, well, maybe they have the opportunity. If the market goes higher, they will be interested in selling. So that's what you want to look at that report from the lens of who's done what at this level of the market. It did not surprise me to see the market move higher from those low points, because I knew that the funds, when they decided the market had gone as low as it could go, they were going to take their profits, which they did. They took their profits, and it drove the market higher. As the market went higher, now the mills go, oh, these prices look interesting for us. We will start to sell. But every time a transaction happens, there is one buyer one seller for every single contract. So they're always equal.
But in the example that we saw, if I remember correctly now, the industry thought prices would fall, majority, 70%. And then Wall Street, as you described it, thought prices would go up. They were long, whilst the industry was short.
Yes, well, currently, Wall Street are long. Wall Street is the buy side. Now, what you have to look at though is how'd they get long? They were buying. So previously, like a few days ago, they were the buyers. Now the market's higher. It's good for them. So while, it looks on the July report where it showed we were at the lows of the market and it showed that the funds had been the sellers, you're like, oh my God, they're dumb. But they're not dumb. They sold it all the way down to that low point, and then they started to buy back their positions.
Super, super interesting. I think that was the last question for this Q&A session. Mike, sincerely, thank you so much. This has been a really valuable and interesting webinar. And I think I speak for everyone when I say that this was very informational, and hopefully more people will start dipping their toes in futures. And if you want to get in touch with Mike, have any questions for him, want to see the recording, get in touch with me and I'll help you out.
And if I could leave everyone with just one thought, the thought is just do it. The size of the contract it's not going to break the bank, especially for a large producer or someone involved in the industry. And I would say that you do it, and 2 years later, you're going to look back and go, oh my, why didn't we do this many, many years ago?
Thank you everyone for joining. Hope to see you at the next forecast room. Otherwise, we wish you a very pleasant holiday season and see you next year at Wood from Finland, Dubai Wood Show, and of course the regular webinar and forecast series. Thank you very much, everyone. Have a great evening or afternoon. Bye-bye. And thank you, Mike.
Am I hanging on?
No, I'll call you on WhatsApp.